Steve, let's start with you. What does the Fed take out of this? I've got to guess that ex-food and energy number up 0.4% is going to be something that causes a little bit of concern.
Yeah, but you know what, Becky? I think this may be a better number than it looks like on first glance, and I'll tell you why. A couple reasons. First of all, I don't know, and I can't really explain it. We have a surge in food prices. I'm not sure where that's from, but it was unexpected. The big swing factor in all this, Becky, is the trade services number. It's kind of a fudge number. It's kind of a real number. It's essentially it's a profits number or a margin number for wholesalers and retailers. It's up 0.7%. It has come down year over year, but remains relatively high. And I think the expectation, I think it's a correct expectation, is that these numbers are going to come down as prices come down. Also, you had a 3.3% decline in energy. I think there was an expectation for there was going to be more of that. You look at what happened to gasoline prices in November. They came down pretty sharply. They're still coming down. And one other thing, when I look up the food chain, I look up to processed goods or unprocessed goods, I see negative numbers coming down the pike. So the headline did not do what was expected. I think you look a little bit into the numbers, and I think Rick kind of said it. This is in the direction of where bonds think inflation is going. Not precisely what was expected, but I still think it's a decent number that is in the right direction of where inflation needs to go.
Megan, do you think this has any impact on the Fed next week? Are we kind of baked into this idea of a 50 basis points with a hawkish sentiment surrounding that?
Yeah, I don't think this has any bearing on what the Fed's going to do next Wednesday. It was a slightly stronger report than what we were hoping for, that's for sure. But it won't shift the Fed off of a 50 basis point hike next week. I think Steve's right to point out that the trade services piece is the most interesting piece in the PPI report, largely because it's imputed from margins. And so it's coming down, still fairly strong. That says something about companies' margins that are still pretty strong. So that's not all bad news. But, you know, PPI used to be considered to be something that leads CPI. That hasn't really been the case. It sort of moves along CPI. And so it was stronger, but I don't think that means that CPI is going to be that much stronger. I think peak inflation is probably behind us. Also, this PPI report was driven mostly by services inflation. That's something that the Fed will pay attention to. They're really worried about services inflation because there's a huge wage component in that. And so insofar as it's really strong, the Fed will worry that wages then will be really strong. And you could end up in a wage price spiral. Looking at the jobs numbers, the jobs report suggests that wage growth has re-accelerated. That's bad news for the Fed. But I don't think we're really in a wage price spiral. It's just something to watch out for.
All right, Chris, take all of that as an investor and try and figure out what to do ahead of this. We've seen some pretty active movement in the futures, seen some pretty decent moves in the yield of the Treasuries complex this morning. But as Rick points out, we're not back to the levels we closed at last week when it comes to, at least to the Treasury yields.
Yeah, this has been a big question, and it's super interesting just looking into the end of the year, which we have a couple of weeks and we have some big catalyst events. The implied volatility around CPI is significantly higher than what we're seeing today. So I think we need to get through those announcements, get through the FOMC meeting. But ultimately, I think for the next couple of weeks, you have this tug of war between really bearish positioning. When you look at things like the put call ratio, obviously at levels we haven't seen since 1997. So the investors are coming into this kind of prepared for bearish markets. So that could create some counter trend. But ultimately, our position, we just released our Outlook 2023 yesterday. Our positioning is quite defensive. We still remain overweight fixed income here, quality fixed income. And the same is true in equities, where you want to be in the sectors that have been able to consistently grow their earnings throughout recessions. Because if the Fed continues on this hawkish trajectory, that is what we're calling for next year.
Meaning what? You like things like utilities and staples?
We like healthcare. We like consumer staples. Essentially, healthcare has been able to grow earnings throughout the past 4 recessions around 8%. Consumer staples have been able to grow earnings around 4.5%. And so we're remaining defensively positioned until we either see a break in the inflation data or a break in employment. And I think given the print today, given our expectations for CPI next week, we may actually get that break in employment before we see inflation come down in a material way.
Hey, Steve, earlier this morning we were talking about all the different points of view when it comes to whether there's going to be a recession next year, whether it will be steep. And it runs the gamut from Treasury Secretary Yellen saying, look, there's still a chance we don't have a recession next year, to some of these CEOs who say, we're anticipating a recession, and as a result, we're cutting back pretty significantly. It seems like this battle is nowhere near being resolved.
Reminds me of a quote from a Dylan song, everybody's either making love or else expecting rain. I mean, that's kind of like where we're at right now. And I think that, I gave the Minority Report on Monday, which is the collection of, I don't know, about 25% of economists who think we skirt the soft landing, which, by the way, includes Goldman Sachs. I think it's worth noting there's a bunch of good economists in it that think we skirt recession. I mean, look, the outlook here is if you can bring down inflation and you don't have a huge surge in the in joblessness, which it's just you can't. I don't think the NBER can go back and date a recession if you don't have a massive increase or a substantial increase in unemployment. It would be a very unusual recession that we had. And I think this issue of labor tightness is going to remain. And Becky, I had the same kind of, what's the right word, just indecisiveness when I did the All-America survey. Yeah, people have really lousy attitudes about the economy, but there's 4.3 million more employed Americans this Christmas than last Christmas. We had a great Black Friday, according to the data. So I don't know. I'm not quite ready to give up on the economy yet.